me to it, because I think it's fair to say this is probably the most uncertain tax environment that I've seen in a very long time. We've had a lot of commitments from the government about what they're not going to change, but there's a few obvious gaps where they just haven't really mentioned anything at all. So I think it's reasonable to assume that we can expect to see some changes in that space. And I think you mentioned BADR, business asset disposal relief, which I think pretty much everybody in the world still refers to as entrepreneurs relief. And genuinely, if I had a pound for every time somebody said that entrepreneurs relief BADR is going to disappear, then probably I wouldn't need to be here today. But
I'm glad you don't.
Yeah, but I think this is probably the time where we might see it disappear. So for those,
but it changed very recently.
It changed a few. Yeah, it changed a few years ago, and we had what was an exceptionally generous lifetime limit of £10 million that you could make gains up to that level, and it came down to only £1 million back in the day a few years ago.
So what's that, £1 million, and you pay
10% tax on the gain on qualifying disposals, which is basically when you're selling a business or shares in a company that's a trading company. So it's still, a reasonably generous relief, and I think a lot of people who do end up qualifying do get a reasonable amount of benefit from it. I mean, it saves you a maximum at the moment of £100,000 if you think it effectively takes that first £1 million of gain down from 20% tax to 10% tax.
Okay. So is that why we're seeing so many people rushing to try and do deals and complete before the budget? I think
that's right, because they have got form for making changes to BADR on budget day. So I wouldn't be at all surprised if they make a change that it'll be effective from the day of the budget. So yeah, there will be, and there are, I know, a lot of people who are rushing to try and complete transactions in advance of the 30th of October, because I think there is a genuine concern that this time we will see a change. I think two things to say about that. You'll see some, what I like to call snake oil salesmen, who'll be saying, oh, well, you need to kind of bank your BADR by doing some kind of artificial transaction, which means that you're selling it, but you're not really selling it. You're taking advantage of some of the rules in a capital gains tax legislation that says if you've got a contract which is unconditional before budget day, then that's the time that you're actually considered to have sold the asset. The government have also got form, or well, all governments have got form in terms of saying, well, if we think you've done something dodgy to try and advance a transaction in order to take advantage of the lower tax rates, we're effectively going to tax you as if you'd done the deal after budget day. So be careful about trying to do something that's a little bit out of the ordinary in order to try and get BADR. And also, I think people have got to be careful about rushing to do a deal and doing a bad deal, which could cost them more on the headline price than they potentially save in tax.
Absolutely.
So it's still got to be the right commercial deal. If it's the right commercial deal and you can get it done before 30 October, great. But if you're rushing to do a deal just because the tax is likely to change, I'd be really wary.
Yeah, no, that's really, really good advice. We often have a bit of a saying here, which is don't let the tax tail wag the commercial dog.
Totally.
So just be careful and be aware.
Yeah, I think that's right. I think, don't rush into something which you may regret. Equally, if you think it's going to get done end of October, beginning November, get it done before the end of October. Yeah. I think that's the key.
Worth a few late nights.
Yeah, absolutely. I think because at the end of the day, even if it is £100,000, that's better in your bank account than it is in HMRC's, frankly.
Fair enough.
So
that's BADR. What about CGT? That's the other thing that everybody's talking about.
Yeah, and this is the.
Sorry, what is CGT?
Well, CGT, capital gains tax, is essentially a tax on selling assets. So I mean, most people, their main asset is their family home. At the moment, that's exempt from any tax if you make a profit on selling it, unless you've kind of rented it out in the past. I don't expect that to change, because that would just mess up the housing market to such an extent that I think it would be totally counterproductive. But other assets that people might have, typically it might be share portfolios. We talked about people who are selling businesses, so over and above the BADR limit, then you're paying capital gains tax at the moment at 20% on selling those sort of businesses. So it's any kind of tangible asset, if you're making a profit on selling it, the chances are you may well have a capital gains tax liability. So I think at the moment the rates are, if we ignore residential property for a moment, the rates are 10% if you're a basic rate taxpayer and 20% if you're a higher rate taxpayer. There's been a lot of speculation that the government are going to increase the rates to the income tax rate, so 20% for our basic rate, 40% for higher rate and 45% for additional rate taxpayers. I'm quite sceptical about that because, again, I think the impact that would have on the market in terms of transactions would be so enormous that actually it could potentially be counterproductive, because if you're paying more tax on gains but people are actually doing less deals, then potentially you end up with less tax overall. So, but I can see it increasing. You know, it could be, you know, let's put an extra 10% on top of each, so basic rate taxpayers pay 20%, higher rate taxpayers pay 30%, for example. I mean, that, you know, that feels like something that's a little bit more, it's not going to be enough to stop people doing deals, but obviously it's going to hit people quite significantly, particularly on larger gains. So I think that's one option. I mean, if they do go for the, you know, effectively the full fat, let's just go to income tax rates, I could see them introducing, we used to have a system years ago called taper relief, which effectively said, yeah, you wince because it was terribly painful at the time, but it essentially said the longer you hold an asset, the less tax that you pay when you sell it. So it was a kind of aimed at encouraging longer term investment.
But it becomes very complex.
It becomes
in terms of calculating the gains.
Absolutely, it really adds an extra layer of complexity, and again, it skews the market a little bit because people might think, well, you know, if I can hold on to this for another 12 months, another 2 years, my capital gains tax rate is going to be lower. But I do think there would be some system that would kind of give people some benefit for holding assets longer.
Right.
Because I think everybody's perception is capital gains are the same as income. Well, they're not. You know, essentially, it's a gain that you make by holding an asset over a long period of time rather than turning up for work each day and getting paid for it at the end of the month. So there's a clear distinction between what we're talking about. Unfortunately, I think the press are guilty of kind of conflating the two.
Yeah.
And
As is often the case.
well, yeah, don't take your tax advice from the newspapers will be the best way to sort of say that. You know, and going back to the BADR conversation, again, historically there's always been some kind of relief for people selling businesses. Back when I was a lad, which is a very long time ago, then there was a relief called retirement relief, which meant that if you were over a certain age when you sold your business, you could get a lower tax rate at that stage. So again, maybe aiming the relief...
Actually, that is interesting, yeah.
Yeah, maybe aiming the relief more at people who are genuinely kind of looking to, I guess, step away from the business and kind of retire in inverted commas, as opposed to what you might call the serial entrepreneurs.
So in the same way as MVLs, for example, you can't operate in the same business within 2 years.
Exactly right. Yeah. So almost focus it, because I think a lot of the criticism about entrepreneurs relief, some of which potentially is justified, is that because it's only a 2-year qualifying period, it doesn't necessarily encourage people to hold on and invest in their businesses in the long term if they make a quick turn on it. So you can see that there would potentially be something, whether that's ready to go on the 30th of October, I'd be pretty sceptical. So we might find there's a gap between BADR going and some other new system being introduced. But I think it kind of feels inevitable that we'll see increases in capital gains tax.
So hold on, there's 2 levels of capital gains tax, aren't there? So there's capital gains tax on property, second properties, which is completely different. Exactly
right. So and this is another area where I think we might see some changes. So if you're selling, as I say, most normal assets, that's probably the right expression, but non-residential property assets, and that can include commercial property, for example, as I say, shares, things like that, then you pay the normal 10 or 20% rates. If you're selling residential property, as I say, if it's been your main home for the whole time that you've owned it, you don't need to worry about capital gains tax at all. But if you've got a second home, which hasn't been your main residence, you might have rented it out, or it might have been a holiday home, then there's a different rate of capital gains tax on those properties, where effectively you pay, if you're a basic rate taxpayer, up to your basic rate level, you pay 18%. and then if you're a higher rate or an additional rate taxpayer, you'd pay 24% instead.
And this now has to be paid within 60 days of
It's actually
completion
correct,
of selling
yeah.
the property.
So
it's quite a tight time frame.
it is a very tight time frame. So you've got an increased capital gains tax rate, and you've got a tighter time frame for actually paying capital gains tax. And I think in the last budget for the Conservative government, Jeremy Hunt brought the rate down on the higher rate taxpayers from 28 to 24.
That's right.
It doesn't take much imagination to say that as a minimum they'll reverse that change.
Right.
But again, I could see an increased rate for residential properties over and above the main rate. So if I'm right and we go for 20 and 30 on non-residential property assets, we might see 25 and 35, for example. I don't know,
Right.
you know.
And actually that kind of, it ties in with this and the previous government's stance on second homes, property entrepreneurs and so on. They're trying to reduce that and open up the market more for people who are going to buy to live rather than buy to let, I suppose.
Exactly right, yeah. It's kind of discouraging people from either having a second home which they use twice a year and leaving it vacant, or alternatively, as you say, kind of building big buy-to-let property portfolios. But to me, there is still a need for a rental market, right? So you've got to sort of balance, the two. And I think my feeling is, and it's slightly off topic, but I think for residential landlords, the pendulum swung a bit too far in the wrong direction now, and we need a bit of a rebalancing. I don't think this is going to be the time that happens, unfortunately.
Interesting. So you've tackled BADR, CGT. What about IHT, which is the other one which is everywhere at the moment? I wrote an article yesterday on it because at the weekend it was in the Telegraph, it was in the Times, it was all over the show. Yeah,
and I think again, because it's not being talked about, then as in by the government, then you've got to feel there are going to be some changes. For those who aren't familiar with IHT, I think there's a few myths that need to be busted, and we haven't got time to sort of do that around IHT at the moment. But if you're a married couple who pass your main residence down to your children when both of you pass away, then effectively you're not going to pay inheritance tax unless the total value of your estate's over £1 million.
Yeah.
So an awful lot of people will never be affected by IHT. Now those kind of what we call the nil rate band hasn't increased for donkey's years, so more and more people are getting sucked into it, but it's still only a relatively small percentage of the population. So a lot of people who get very excited about IHT probably don't have any need to worry about it at all. I can't see anything that...
However, that would then suggest that, what was the terminology that Keir said, that it's going to be painful and the people with the broadest shoulders are going to feel it most.
Exactly, and I think that's that's really the point here, is that the people who are paying IHT, first of all, cynically, they're not necessarily traditional Labour voters, but secondly, arguably, they can afford it more. The problem for a lot of people with inheritance tax is they tend to be asset rich and cash poor. So if you've got a big inheritance tax bill, and inheritance tax, once you go over that threshold of £1 million, say, is at 40% on death. So it's a serious amount of money. And you do end up with people having to realise assets on, following their loved ones passing away in order to be able to pay the IHT bill. You can pay it by instalments, but it's still a cost that has to be dealt with.
So I think we need a completely separate video and article session on IHT, because I've got so many questions I want to ask which probably aren't for now, but go on then, your predictions for what might happen.
Yeah, and I think, interestingly, one of the areas I think we might see a change is that interaction between capital gains tax and inheritance tax. So as matters stand at the moment, if somebody passes away and they own assets, whether it's shares in a business or a residential property, then the beneficiaries of their estate are considered for capital gains tax to have almost bought that asset at the probate value at the date that the individual who's passed the property on dies. So what that means is, if I own a property that's worth £1 million, I pass away and I pass that on to my son, then he's considered for capital gains tax purposes as if he bought that property on the day that I passed away for £1 million.
Oh, okay. So you don't pay, you nor he pays capital gains on it. If you bought the property yourself for 300,000,
Exactly.
it's now worth 700,000 or a million.
Yeah.
There's that 700,000 that has no capital gains
Correct.
tax.
Yeah, and he then sold it the following day for £1 million. He paid no capital gains tax on the sale as well. So there's a nice tax-free, what we call an uplift in the cost for capital gains tax purposes. Thinking then about inheritance tax, if that had just been a residential property that I was letting out, let's say it wasn't my main home, then that would have been subject to inheritance tax at 40% above the nil rate ban. But if that had been shares in a business, shares in a company, a trading company, for example, or if it had been agricultural land, then there would have been potentially no inheritance tax on that. So you're kind of getting a double dip in that scenario, because there's no inheritance tax, but the next generation are still getting an uplift in their capital gains tax base cost. So there's almost a double benefit, and this is why a lot of people will take the view that actually death's the best form of tax planning, because if you hold assets until you die, then and they're outside the inheritance tax net, then they get passed on, and it's kind of a tax-free gain for the next generation if they decide to sell the assets.
Which segues beautifully into pensions, actually. So I hadn't even thought about this, but pensions are another asset which you can pass down. Free of tax.
Yeah, absolutely.
So
yeah.
Do you think they might hit on that as well?
I wouldn't be at all surprised. So I think on the IHT, from what I can see them saying, is effectively, if you get the relief from inheritance tax, then you don't get that tax-free step up in the base cost. So
you get one or the other.
Yeah, exactly. So let's say I formed a business 20 years ago and I put £100 a share capital in, and when I die it's worth £10 million. At the moment that will be transferred for capital gains tax at £10 million value, and there'll be no inheritance tax on it. My guess is, and it is no more than a guess really, is it might still escape inheritance tax, but it's deemed to be transferred for £100, which is what I originally paid for it. So as if my children, if Toby, my son, sold it, then he paid capital gains tax on the full 10 million value of the property. And you're taking away that double bubble, if you like, that double benefit that people get from kind of holding on to assets until they pass away. And you're right, you know, people have very big pension pots. We're constantly encouraged to save for our retirement, but at the same time, the government's not averse to dipping into those pension pots if it needs to raise revenue. At the moment, those pension pots are completely outside of the individual's estate for inheritance tax purposes. It wouldn't be a hard change to actually bring those pots into the estate and say, well, if you've got a pension pot of £1 million, then potentially there's 40% inheritance tax on that. They might generously say, and you can dip into the pension pot to pay the inheritance tax. But again, you could see how that would be a change that they could potentially make, which again, arguably from their perspective, doesn't hit their core vote, because their core vote may not necessarily be people. And you know, I'm obviously making the stereotyping to a certain extent, but you could say in the past your typical Labour voter is unlikely to have had a really significant pension pot. Whereas the people with the broader shoulders financially would typically have quite large pension pots, which at the moment fully escape IHT. So you can kind of see that will be an easy option for them. And a lot of people who squeal about it, you know, may not potentially attract an awful lot of sympathy, because they're already passing on a great deal of wealth.
And I suppose it wouldn't impact on the government employed sectors, because their final salary or defined benefits pension schemes aren't passed down, they die with you, is that correct?
I think, or perhaps there's a very small, I think there may be a widow's pension or a widow or widower's pension, but it's a significantly lower value than you would have in the case of a sort of a defined contribution as opposed to a defined benefit pension scheme. So again, you know, what they'll be looking for is things that, and some of this frankly is gesture politics, I've got to be honest, because taking away business asset disposal relief for an individual, it hurts. In terms of the revenue that it raised, it's not going to be enough to plug this so-called 22 billion pound black hole. So it might be an accumulation of measures. The other one on pensions is, at the moment, if you're a higher rate taxpayer and you make a personal contribution to your pension, you get your basic rate relief because effectively the government enhances your pension contribution in the fund, but then you're also able to get some of that higher rate tax back on the pension contribution that you've made. Again, there's been speculation for years that would go. It feels like that could be a decent revenue raiser for them, and again would only hit the perceived more wealthy who are kind of getting in the high rate band and therefore able to benefit from that relief as well.
Interesting. Do you see anything further for businesses and employees in your mind? You've got Badar, we've talked about. Corporation tax rates have just changed recently. The national insurance contributions for employees and sole traders have changed recently, but employers' national insurance contribution has continued to remain at the 13.8%, while employees has reduced. Dividend tax rates haven't changed for a few years, but the allowance, the tax-free allowance, has come down. Have you got any thoughts or ideas there?
No optimistic ones, it has to be said. I think the last government put in some measure to encourage people to make capital investment, and I can imagine that those will continue. I'd like to think that there'd be a little bit of a review of the R&D tax credits regime, because HMRC are busily trying to police it out of existence at the moment.
It's another area where the pensions perhaps swung too far.
Exactly, yeah.
There was a need for it to be redressed, but...
Yeah, and I think it's the classic where there's been a few bad apples have kind of soured the barrel for everybody, really. And I'm not convinced that the regime as it stands really is fit for purpose, in the sense that I don't know that it necessarily does encourage. The idea of the scheme was to give people tax back to allow them to reinvest into R&D and to continue to be innovative and to sort of create value through that process. So it needs people who really understand the system and how R&D works in the broader context, to kind of take a proper look at it and say, are we providing the right incentives? Are we actually driving the right behaviours through the system? Rather than constantly, what governments tend to do, messing about and kind of responding to a perceived issue, let's take a step back and look at all of these investment incentives, whether it's capital investment, whether it's R&D type incentives, or whether it's actually investing in your workforce. I'd really love to see them take a step back and say, okay, clean sheet of paper, rather than fixing a broken system, why don't we kind of just go back to day one and essentially say, if we were designing a system that is actually fit for modern day. There's so much about the tax system that was developed in, let's be honest, late 19th century, sort of 20th century.
So not just before the evolution of AI, before the evolution of the internet, before...
It doesn't deal with the modern digital businesses of today. So it's whether they've got the courage to actually take a step back and re-look at all of these things. They're talking about being very business friendly. Well, business has been crying out, one, for certainty, and two, for incentives that actually drive the right behaviours. So there is a massive opportunity for them to kind of come in and say, well, okay, and let's get the right people around the table. And that's not Treasury officials who, no disrespect, but they've never actually worked in the real world. Get business leaders around the table, get people who are really highly sort of placed in R&D activities, to actually get people around the table who understand these things and say what would actually work for businesses. I think if they could do something like that, then actually start to use the tax system in a positive way to encourage people, rather than in a negative way to almost typically, we'll put incentives out there, but we'll make it so hard for people to claim that they almost become pointless. So let's be brave. Let's actually, redesign the thing so it actually works, rather than constantly just fixing perceived problems. I think now that's more a hope than an expectation, but they have an opportunity to do that, and I'd love to see them take it.
Be brave. That's a good mantra for it.
Absolutely.
Excellent. Paul, thank you so much.
Pleasure.
That's absolutely fantastic. I think you've given us lots of food for thought, and let's see what happens in October.
Yeah, I can't wait. I think.
Thanks very much.
Thanks.